Good afternoon, ladies and gentlemen. On behalf of MCCI, I extend a warm welcome to all of you in this very special e-session called Recent Regulatory Initiatives in the Securities Market. Friends, the Indian stock markets have been having quite a ride in the recent times. Between November 2019 and November 2020, Nifty has seen a growth of 7.57% and Sensex of 8.23%. This would have been considered a steady growth under normal circumstances, but then this period has not been normal given the COVID-19 pandemic. The COVID-19 pandemic is a unique socio-economic situation like never before. The pandemic has caused lockdown and restrictions of activities globally, and that has almost halted the global economy. India too is reeling under the impact as recent GDP estimates clearly show Indian GDP is yet to reach the full heights of the pre-COVID period. Nonetheless, Indian stocks gained the most among the world's top 10 nations by market value this fiscal, underscoring the strength of the rally that remained unshaken by COVID-induced turmoil and economic uncertainties. India's aggregate market capitalization soared 88% in dollar terms this fiscal year 2021, the sharpest increase since financial year 11. While we are all aware of the bull run in the bourses, what is often overlooked is the role played by the regulators in maintaining discipline and best practices during such runs. SEBI has come a long way to initiate a lot of reforms to make the market safer for investors. It has probed over 90 new cases for flouting security laws in the year 2021 alone. SEBI has also initiated some key new regulatory initiatives during this period, such as the new peak margin rules that came into effect from the 1st of September 2021, the merger of SEBI Share-Based Employee Benefits Regulations 2014, also known as the SBEB regulations, and the SEBI Issue of Sweat Equity Regulations 2002, also known as Sweat Equity Regulations, into the SEBI Share-Based Employee Benefits and Sweat Equity Regulations 2021. New rules pertaining to the appointment, removal, and remuneration of independent directors that is expected to come into effect from the 1st of January 2022. To know more about these regulatory initiatives in the securities market, we're extremely glad to have with us today Shri Santosh Kumar Mohanty, Whole-Time Director, Security Exchange Board of India, SEBI. Prior to this role, Shri Mohanty also served as the Executive Director of SEBI. He has also served as the Commissioner of Income Tax and an Assistant Development Officer at NABARD. Shri Mohanty completed his Masters in International Studies from the Jawaharlal Nehru University and has the Bachelor's degree in Law from Mumbai University. On behalf of MCCI and all the gathered audience, I particularly thank Shri Santosh Kumar Mohanty for accepting our invite and gracing us with his presence despite his busy schedule. Without much ado, I now request Shri Mohanty to kindly share his address with the audience. Thank you. Thank you, sir, for joining us, and over to you.
Thank you, Rishabh-ji, for that nice introduction and nice introductory address as well, which I think has set the tone now for the discussion. And when I was given this, actually this is a very tough call in the sense, normally when people ask us to talk, they give us a topic and we decide what to talk, what not to talk, how much to talk and all that. But MCCI has really taken an innovative step in this matter in the sense they gave me every liberty to decide my time, my date, my topic. I just want to, the way I want to express, whatever I want to express and share before you. So that is something I'm very privileged, and I'm thankful to MCCI for giving me this opportunity. And in fact, not very often, quite often, I think this is the first time I'm talking to any Chamber of Commerce or Industry body from the eastern side. I haven't. When I was dealing with commodity market, I had been to Kolkata on certain specific issues to meet the commodity brokers, but I have not spoken to the industry and commerce body as such earlier. Now that freedom has been given to me, And definitely, and SEBI has done quite a bit over the last couple of years, especially in the pandemic time. SEBI has been most effective and active as well. And you must have all seen that during the last 18 months, especially when the pandemic started and the market plunged by about 40% on 23rd of March 2020, and nobody was knowing what is going to happen. The so-called Black Swan event took place and it took everyone by surprise. We are not really, nobody had an experience of dealing with this kind of a worst case scenario. Normally we built a worst case scenario into our risk management system, but this kind of a worst case scenario been worse, how bad, how ugly it is vis-a-vis the 2008 financial crisis. Nobody was knowing, having any clue. We were bombarded with demands for suspending the market, banning the short selling, or giving a limited hours to this market, and so on and so forth. But luckily and thankfully, because of our tenacity and because of the tenacity and robustness of this market and the risk management that is in place, they really stood the test of time, and we didn't have to do anything extraordinary to keep the market running. Just a little bit of squeezing the position limit or curtailing the speculative element, little bit of nifty position, etc. We didn't have to do much. The collaterals with the exchanges were quite substantial and adequate to take care of the default scenario. No default ever occurred. And this is something I must give credit to the entire system of trading that we have put in place. The collateral, the securities that the brokers and clearing members they placed before the clearing corporation, and the way market conducted also despite COVID, ban from city to city, state to state, restrictions, and we used to really fight because this is the only market which had the entry and exit option at that particular point of time when people wanted to either monetize their asset or taking advantage of the fall down in the price. Some people also wanted to consolidate their asset position as far as stock market is concerned. So I don't have to repeat. Most of you know during COVID times, SEBI took a lot of extraordinary measures to keep the market intact and going on in a manner that people shouldn't suffer. And starting with what Rishabh pointed out, that this upfront margin and all that we have started. In fact, today we had a meeting with the Standing Committee, Parliamentary Standing Committee of Finance. They also expressed their apprehension about this market, the way it is going up and up, and the apprehension about a possible bubble, or how SEBI is prepared to tackle the bubble if so it comes. If there is again plunge in the market corrects very severely, what is that SEBI is going to do? And why is that market is going up? So all of us know why the market is going up. People must be reading a newspaper. Everyone talks about a lot of liquidity in the market and also negative or very little interest that people are getting in fixed income category like FDs and all. So, and definitely people are disincentivized to keep their money in the banking system, and they need an avenue to park their money in a place where at least they get more than what is the banking system is offering. And apart from that, of course, it was explained and everybody knows that the new age investors, the millionaires, the professionals who are sitting at home and working, they also found, and these discount brokerage firms, they're making it so easy, the easy KYC that SEBI has facilitated. When sitting at home also, you can do video KYC and get yourself registered as a trader, open a trading account, open a demat account. And of course, same mobile phone you use, transfer money in and out, and start trading with your fingers. So this kind of facilitation, technology, and the incentives caused by the fixed income category assets, and hardly any interest being offered, return being offered. And at the same time, so easy to invest in this market, and all compounding together, people have started definitely reposing faith in this market. Apart from the fact that the market, this is the only market which got never disturbed, no disruption whatsoever. It is continuing ever since, as it was continuing earlier pre-COVID also. And rather, we have rose up to the occasion, and this is the time we should take notice That's sometimes is something, God willing, God forbid, something happens, the market corrects. What to do? I mean, the first minus and first yield that we found that people are trading not only with their own money, they're also trading with the borrowed money from the brokers and from others and BFCs and all that. So as a result, paying hardly any margin, people are being allowed and permitted, encouraged to trade. So therefore, at least we should do this much. At least somebody wants to trade, let him trade with his own money only. And therefore, the intraday as well as the long-term delivery-based trades, we said upfront margining has to be there. And from 1st of September, I think all of us know, 100% upfront margin based on the peak margin that is being computed by the stock exchanges. So everybody has to pay. At least one stance committed from the beginning itself that I'm paying my margin before I trade. And so when I pay my margin upfront, I know that what I'm going to do with the during the course of the trading time. So this is something. Then also, of course, to keep the investors safe and hell and hearty as far as the trading is concerned. So you must be knowing these replace mechanism was put into place so that the Peter's shares is not appropriated for Paul's benefit or vice versa by the broker. And my shares will be used against my default only, against the call of margin being made by the broker to me. My shares will be used, not it cannot be appropriated for anybody else's margin calls. So my securities is protected. I am paying upfront margin. Now I am conscious of what I'm doing. So at least this much people should know before they trade, because in any case I'm trading in an asset which is a risk, basically it has risk. Therefore, this is something we wanted to make the market safe for the investors before we say sorry, and they say also sorry for having taken the plunge under the guidance or misguidance by some other people. So as far as safety margining system is robust in the securities market, and the collateral system is robust, and clearing with the interoperability of the clearing corporations, this clearing and settlement is also happening seamlessly and with more cost effectiveness as it used to be compared to what it used to be earlier. Coming to the recent regulatory initiative, that again I would like to, because this is something we have been taking action every now and then. SEBI administers over not less than 35-40 regulations apart from the acts provisions, and the ecosystem is full of intermediaries between the investors and the issuers. The whole ecosystem is full of regulated intermediaries, be it stockbrokers, merchant bankers, to credit rating agencies, to RTAs, to portfolio managers or investment advisors and the mutual funds. All are basically intermediaries. Basically, the market comprises three I's: issuers, investors, and all the whole array of intermediaries that comprise this. They give their financial and capital market services to all of us as investors. So to put them in check, there has to be a mid path between the balancing act is very tight. Between over regulation or under regulation, we have to have a mid path. At the same time, developmental activities as well as investor protection. So within these four corners of the four strong pillars, the market development, investors protection, and at the same time regulation and monitoring and disciplining the market. So SEBI walks this tightrope walking and does it perfectly fine. Sometimes SEBI also invites criticism. That's part of the game for any regulator for that matter. But over the years, what we have seen, a lot of activity has come. Not because I'm just not telling people have come and the demand is there, a lot of liquidity, a market is going up. And SEBI, I don't want to take any credit on behalf of SEBI, or SEBI also doesn't want to take any credit, because its entire financial market structure is such that whoever has surplus money, he or she wants to come and try this market. And you must have seen more than 2 crores of demand accounts have been added up to the CDSL's depository system, because CDSL is primarily retail depository, and over the last 2 years. And similarly, a lot of trading accounts, more than 1.5 crore have been added up, and more than 500 crore people are trading. Out of them, at least what I'm given to understand, at any point of time, 2 crore people are active traders. So with such system, and the mutual funds have also, they have added their asset under management has gone up to 35 lakh crore on the one hand, and about 4 to 5, 6 lakh crore together PMS, you can say, and alternative investment funds, they are having the assets sitting over those assets. So this money, and also the SIP, I am told 2 crore SIPs are there, new SIPs have been opened, systematic, monthly systematic plan, investment plan. And of course, the of late EPFO and pension funds, they've started taking more and more exposure to equity market as well. So as a result, what has happened, even though this particular current financial year, the FPIs are giving net outflow, they're negative in the equity market, still the market is holding on to its bullish trend because of solid support. And when I think there's a trend when the FPIs start selling, the mutual funds and other HNIs or institutional segment buyers, they start buying or something. And of course, retail investors, they're showing interest in this market. So this is one good thing has happened over the last 1.5 year or recent time, that we are not so critically dependent on the moods and swings of the hot money that was being propelled by these FPIs. So they may come and they may go. Still, the market will try to adhere to the fundamentals instead of getting completely volatile depending on the mood swings of the FPIs and their in and out. So even though people have started talking about the 2013 taper tantrum, etc., because of some announcement speeches by the Fed authorities, still I think Fed authorities have not told that they are going to stop buying assets and all that. They have not said that they're going to raise the interest rate, and they are also guarded, and they are saying that whenever it will happen very, very cautiously, calibrated manner and all that. So therefore, given the fact that this time people are not expecting that suddenly there'll be a rush of outflow of money of FPI from India or emerging capital markets, because the tapering of US Fed also will not be so sudden, and can be over a graduated manner over a long period of time. At the same time, the fundamentals of Indian capital market has also got consolidated in between, thanks to COVID or whatever, because of the liquidity and because of the new ways and new emerging class of investors, that depending on the fundamentals, also market will hold on to it. It will just not get swung by the mood swings or drastic action by any other like FPIs or any good big influential category of investors. So given this fact, I would say then, if that is the fundamental, what is the fundamental? Because COVID is supposed to kill the economy. There is a disconnect between the market and the economy. That's what the people talk about. But if you really granularly analyze, not every segment of this economy, not every segment of the corporate sector has suffered. People have rather tried to take care of their balance sheet in a very pragmatic manner because of cost cutting and other things. And the debit side of the profit and loss account has been taken care of so strongly that even if the revenue has stagnated or even reduced a bit, and a lot of deleveraging has happened over the time. And as a result, it is amusing to see a lot of corporate results are showing very, very good returns, and the quarterly results are also encouraging. So therefore, net and net, even though COVID third wave comes, or whatever it is, we don't know what is going to come. Certain uncertainty is the second name of this market. Uncertainty will always remain. Volatility will always remain. The VIX, which was 80 during the peak time, now VIX is showing 15, which is quite volatility index, which is quite normal, as economists point out. So net, I think the security market has really started maturing a bit, and the capital market has really started maturing a bit. So all that we need, that more discipline has to be infused, more developmental activity has to be infused, new products and some innovative and technology has to be taken care of. With this, the set of narratives as a background, I just would like to place before you in brief what are the things that we have taken so far. You must have seen that during the COVID time, we have streamlined the rights issue as far as the primary market is concerned. And first time rights entitlements were traded. when Reliance Group came out of it with it. And so the first track rights issue has really paid off. A lot of companies have raised rights issue during the COVID time. And we have also given special dispensation to the companies having stressed assets, where even though the promoters infuse capital by way of preferential issues and all, we have exempted from them from takeover code and given a very relaxed kind of environment so that they can easily infuse funds without getting bothered about other regulations of the SEBI like takeover code. And forensic audit reports, etc., because that has become little more frequent because of either compulsion or because of foul playing, whatever it is. So we have told the companies to put forth the forensic audit report whenever it is initiated and whenever it is completed by the company. And there should not be any information asymmetry as far as the governance is concerned. And the forensic audit contents have to be timely disseminated. So we have also made life easy for the promoters. Some of the promoters are barely having any shares less than 1%, but they are being called promoter, and having this onerous, the burden of discharging the responsibility of promoter, and sometimes if the company does some foul play, those promoters are also held. So we have liberalized the system for reclassification of promoter. Somebody wants to get himself or herself as a reclassified as non-promoter, so he can do so. And those procedures part, we have taken care that it doesn't become burdensome anymore. So no more requirement for shareholder approval also if somebody is below 1%. We have strengthened the risk management committee of the corporates, and we have a risk management committee has to be manned by independent directors, and they have to be very careful, and in terms of they have to have a policy of risk management, and at least one independent director has to be there. So that part, risk management committee, audit committee, we have strengthened. And in terms of listing obligations and disclosure requirements, we have also done a lot of tightening as well as liberalizing in terms of procedure, but tightening in the sense dividend distribution policy has to be now declared by top 1,000 companies. And in case of board meetings held for more than one day, at least the day the financial results are discussed, so within 30 minutes, they have to, from the end of the board meeting, they have to disseminate. So earlier, there used to be a little time lag of dissemination of financial results. So a lot of manipulations were happening. And the provisions of LODR regulations which become applicable to listed entities based on market capitalization criteria shall also continue to apply even if the entities fall below the specified thresholds. So once you are above threshold, no matter you have gone down, you'll continue with the disclosures. And all of you know that in public relaxation in the minimum public offer requirements for large issuers, we have done it. Now, if one issuer is coming out at the post issue of size more than 1 lakh crore, so they have to at least offer minimum 5,000 crore plus 5% of the post issue market. Otherwise, the 10% norm was there for anyone coming out with a post issue of 4,000 crore and above earlier. So promoters, these minimum promoters contribution, that also we have relaxed recently. So instead of 3 years, the promoters can, the lock-in period is now it is only 18 months. And for non-promoter, it was 1 year. So it will become now 6 months. So as a result, the promoter can get out and invest in wherever he wants because of this rapidly changing environment. We don't want the promoters to get stuck to the company with their 20% with 18 years, provided the fact that the money that he has raised is not used for capital projects. If it is for general corporate purposes, the promoter can get out in 18 months. So we have facilitated e-voting facility, made it very, very easy now. And through depository system, the shareholders can simply log in with a single OTP authentication and can give their votes. And one thing was there about the analyst meet, investors meets, etc. that used to happen every quarterly results, after every quarterly results. So little bit of opacity was there. Now we have also said that you have to disseminate the transcripts, the video recordings, audio recordings of all these quarterly calls as soon as immediately, so that people also should get to know what the analysts ask questions to the promoters or their officers, what answers they gave, there should not be any information asymmetry between the investors and also the so-called, the little privileged kind of investors, institutional, who really join the attend the analyst call, and they go and meet the company people after the quarterly results. One of the good event that has happened is business responsibility and sustainability reporting by listed entities, which will be mandatory from FY 22-23 and optional for 21-22. So basically, this BRSR 6 disclosure from listed entities on their performance against the 9 principles of national guidelines on responsible business conduct. And reporting under each principle is again divided into essential category and leadership indicators. Essential indicators are required to be reported on a mandatory basis, while the reporting of leadership indicators is on voluntary basis. So now they have to disclose in their, along with an annual report, the BSR reporting has to be there. And the essential category also is very comprehensive. It includes all their greenhouse emissions and other kind of pollutions that they are spreading, or host of categories are there under which they have to report. It's very exhaustive. You can have a look at it. And I'm sure no other jurisdiction has so far mandatorily prescribed. In IOSCO and all things are still under discussion level. And there's a committee of the international standard benchmarking agencies, after which they are going to float a consultation paper and start telling countries to follow that. But before that, we have done it, and we have also consulted international benchmarking organizations. So if anything extra has to be done, we can do later on. One of the contentious issue for in the primary market corporate governance is independent director, as all of you know. And we have recently a little bit changed the norms regarding appointment and reappointment and removal of the IDs, which can happen only through special resolutions of shareholders. So at least in the special resolutions, shareholders will have some voice. Otherwise, it was completely, many a times complaints used to come that the promoters, they have their own voice, they take their own people, and so to some extent, this may address, and the role of nomination, NRC, Nomination Remuneration Committee, has been enhanced. A lot of disclosure has to happen before they recommend somebody's name, what kind of skill set he's having, possessing, or kind of skill set that is required and all that. So this is one area, and also regulatory framework for promoter and promoter group company. Also, we have done something in the sense it has been made easy, like a particular financial institution. They have 20% stake in one company, and also they have 20% stake in the promoter company, issuer company. They were being clubbed as a promoter group company. So that was creating problem for the private equity funds and other financial who were basically financial investor. We have removed them from the list of the definition of promoter group companies. So there's some relaxation has been made. And as Rishabh has also pointed out, recently we have done this merger of two earlier regulation on share-based employee benefits and sweet equity regulations, and we have made also life simpler. The permanent employee definition has been discarded, and a lot of flexibility has been given to companies to give shares based on the sweet equity formula, or as well as employee benefits as a matter of employee benefits through trust model or through any other schemes that they can have. So one more thing is I think these are all mostly important things I've touched about the primary market. Yeah, IGP one framework is the innovative growth platform, you must have heard. There we have done a lot of changes. Of course, till now there is no traction. It is meant for the new ways, innovative and technologically intensive companies, data analytics companies, who can simply come and raise 10 crores also. And it has been made so simple. Their takeover regulations and the delisting regulations applicable to is much simpler, and they can in fact start giving discretionary allotment to about 60% of their to institutional investors, and their earlier it was required the pre-issue capital should be held at least for 2 years up to 25%. That has been made to 1 year. So it has become very, very attractive, but so far traction has not come to this. The thing that you must have seen, like Zomato and other, there's a line of before our department of the techno companies like Paytm, Nykaa, and so many others. I can name many of them. And they started coming to get listed and started believing in the capital market of India. And I'm hearing also those what they use a word called flipping, where the new age startups they start opening their registered office in overseas jurisdiction, so as to escape, so-called escape from the regulatory burden of India, and they can get listed over there and all that, raise money. Although their entire business operation is in India, but some of them have started rethinking, and they're calling it reverse flipping. Now they may come over to India once again, and they start getting listed here. Perhaps they have found that Indian investors are also giving them due recognition and due valuation as they deserve. So in that case, of course, we are hopeful that a lot of wealth can be created in public space by our Indian investors who are really giving them genuine revenues for their business models. And primary market have touched. Social stock exchange is something I want to talk about, but this is also this is a work in progress going on, and maybe shortly we'll come out with a board agenda and we'll get it approved, and we'll start having a new segment of social stock exchange where Section 8 companies and other NGOs can come forth and raise money, and new instruments can also be created like impact bonds and others. And that is something in the pipeline. And maybe the money raising by the NGOs for charitable and philanthropic work will be much more simpler, transparent, as well as with a lot of responsibility. They'll do it because they'll be under regulation as well. So these are some of the few things that I wanted to talk about primary market. And about the secondary market, I told you that on developmental side, maybe in commodity side, gold spot exchange is something that is forthcoming. So maybe electronic gold receipts, EGR, as a new security that is going to be notified by Government of India, which is under proposal. Then maybe things will be simpler, and EGR simply will become a security, and gold spot exchange can become just additional segment in the existing gold exchanges as well, apart from new exchanges if anybody wants to open. And so that maybe the gold trading in the country, particularly of those as well as the LBMA variety, as well as the India gold standards developed by the BIS, they can be really easily traded and with a lot of transparency. And you know that futures on commodity indices also have started, which is cash settled contract, and is something new product that we have come out in the secondary market. Option in goods definitely is going on for quite some time. And in equity side, of course, most of the products have been there. Weekly options and all derivative products are there. Of late, exchanges have not come forward with any new product per se. But we are always on the job. We have given recently guidelines on business continuity plan, disaster recovery, technical glitches of NSE. You are all aware, and we are trying to take care of this. And a lot of financial incentives we have imposed on them. At the same time, we have asked them to go to the DR site within 45 minutes. If you can't go, then you have to pay heavily. So standard operating procedure for handling technical glitches have been already framed. As I told you, for investor protection, upfront collection of margin and permitting cross margining benefit also in commodity index futures have also been permitted. Collective investment vehicles, after the Franklin Templeton issue, and also before that, as soon as the ILFS happened, fiasco and crisis. So the debt market, particularly debt investment, debt mutual fund schemes, they have come under fire, along with the role of credit rating agencies, and a lot of disciplinary measures as well as reformative actions, reform actions have been taken by SEBI, including their liquidity risk management, then the stress test testing, and fair market valuation. Any instrument exceeding 30 days, amortization completely stopped, and the third party agency is going to give valuation. Nobody can do amortization, and then potential risk class matrix for debt schemes based on interest rate risk and credit risk. This is also has been prescribed for the credit rating agency to develop, as well as the mutual funds to do on their own also. And the sectoral exposure, single company exposure, 10% asset under management must be kept in liquid funds to meet the liquidity crisis. All those things have also been told to them and prescribed to them over the period of time. And so this and also of late, the aligning of the interest of the fund house, their management, their CEOs, their fund managers, with the interest of the unit holders, as well as the AMC's interest with the scheme, by prescribing that there's some amount of money, substantial money they have to invest from asset management, and also 20% of the remuneration pay package of these officers have to also be invested in these schemes that they are believing in, that these schemes that they're promoting, and the schemes they're managing. So as a result of that, hopefully more responsible management of funds will come in near future, and probably things will be in a better format, as because AMC are having their AUMs increasing from week to week. And similarly in debt equity side also, true to label, rationalization of the categories, and again having some amount of prescribed liquidity maintained at any point of time. All those things have been prescribed. Mutual fund forthcoming, again, swing pricing is something that is already in the consultation paper. We are coming out with it. And listing of mutual fund schemes that are in the process of wind up also, this is something on the anvil. Investor protection, as I told, alignment of interests of key employees of the AMCs and norms regarding investment in additional 81 tier 1 and tier 2 bonds also. You have seen that SEBI has said that it cannot be in perpetuity, or it cannot be valued for only 10 years or till the call option. It has to be for 100 years or something. So that mis-selling on that, SEBI also has come down heavily, that it cannot be sold except for to the institutional buyers, and retail should not subscribe to 81 and tier 2 bonds. And the revamped riskometer, you must have seen. It's a dynamic concept that they have to, on a constant basis, they have to upgrade their riskometer mutual fund, so that at any point of time, I should know the latest position of this fund and the scheme as far as the risk that is posing to, that is involved in the scheme. So then bond market, developmental role, you have electronic book provider platform, EBP, which has become a very transparent platform in the exchanges, where the people are raising capital, the companies and corporate sector and institutions, for raising bonds, issuing bonds. And the request for quote platform is a secondary market platform, where also SEBI has prescribed mutual funds are the major buyers and sellers of corporate bonds. So 10% of their buy and sell they have to do through the RFQ code, so as to infuse some liquidity into the RFQ code. And you must have heard about the limited purpose clearing corporation that is coming up, as well as the backstop facility for corporate debt securities announced in the union budget, that is also coming up, which is going to buy mutual corporate bonds irrespective of the grades, spanning across AAA to default and investment grade, both in normal and good times, normal times and bad times. And LPCC is going to provide repo operation with market making, so as to infuse a lot of liquidity in secondary market. So SEBI from its end is on its own has been taking a lot of initiative to create a lot of liquidity in secondary market. As all of us know that bond market really needs, although 7 to 8 lakh crores are being raised in the primary market, which is a very good thing. People have reposed faith in the bond market as an alternative venue for raising their much needed capital, as the banks have started becoming risk averse and not really sanctioning big ticket loans. So at the same time, those issuances have to be traded in the secondary market for giving easy entry and exit up to the buyers and sellers. So that is something on which SEBI is working. And debt securities issued on private placement basis also now, the timelines for listing of that also has been reduced to T+4 trading day. Then I would talk about a little bit of intermediaries. The fit and proper also persons, SEBI has ensured market integrity by ensuring fit and proper persons only to get registered. So that's something we are working on. Again, we'll ensure that no unscrupulous or spurious kind of entities come and start giving intermediary services. And use of technology for KYC, video KYC. You must have heard about regulatory sandbox, where an innovative sandbox. Innovative sandbox, when somebody can come and take historical data from the exchanges and depositories and try out their products. And the regulatory sandbox is that where somebody can come and try out his novel idea or innovative product on a live trade data, so that after testing, if it is a good product, people can use it and it can get licensed. So a lot of applications are coming of late, and we have a committee, FinTech committee, which is seeing it, and also our internal committee is selecting the applications for further trial. You must have seen investment advisor, portfolio manager, alternate investment funds. They were little loosely, slightly loosely regulated. There also we have tried to bring a lot of transparency, because of a lot of unethical and unregulated, unregistered investment advisory cropping up in many parts of the country, particularly Indore. I don't know what is the beauty of Indore. Dozens and dozens of unregistered investment advisors, they are soliciting money and investment from throughout the country and creating a lot of troubles for us. So there are also a lot of transparency, and we have made them corporatized. We are encouraging a lot of in terms of net worth and their business. SEBI has come down with a lot of measures. Going forward, we are coming out with a good investor charter, which will definitely tell the investors what is their duties, roles, responsibilities, rights, and especially will be focusing on in grievance redressal mechanism. Accredited investor concept has come up, where if somebody gets himself as accredited investor, then he'll get a very lighter kind of regime for doing his trade and investment, and the collective pool mechanism, the mutual funds, investment, alternate investment funds, etc. They'll also can give very flexible products to them without being bothered by regulatory tightness, because they themselves are accredited investors. They know the things, so they'll take the risk onto themselves. So this is something we have come out with. And blockchain technology is being encouraged, and depositories are going to adopt blockchain as far as the charge creation and the maintenance of the properties, etc. concerned pertaining to debt market. So net, I'll say over the last few, you can say, I think during COVID time, when people were doing busy restoring to their business and trying to catch up with their pre-COVID times as far as the business profession is concerned and all that. So SEBI also took the opportunity to do a lot of reform work, and a lot of regulatory initiatives have been taken. And starting from primary market, secondary market, I told you investment fund activities, and also intermediaries, credit rating agencies. All around we have tried to focus. We have not left out anything. And also technology, cyber security, so that nothing is left out from the ambit. And I'll stop at that. I think I can go on. So every subject itself is a subject for giving 1.5 hour or 1 hour presentation. So in the interest of time, I'll stop at that. I'll rather take some queries if people have. Thanks a lot for again giving me the opportunity for speaking to you all.
Thank you, Santosh. That was really illuminating. I also take this opportunity to welcome our chair for Council of Capital Markets, Subodhji. Thank you, Subodhji, for joining us.
Rishabhji, my apology to Santoshji and Rishabhji. I got stuck in some other meeting, so I could not take entire benefit of Mohantyji's deliberations. But yes, partly I could take benefit. Excellent deliberation. Yes.
It was really thorough, sir. I mean, the expanse of the thoroughness was very impressive. So, Subodhji, there are some questions in the chat, and जो members से भी आए हैं, so I request you to take over. And
thank you, Rishabhji. We have got many questions. I have got in my mobile also. Santoshji, a lot of questions has come. Up to what time we can keep on throwing question on you, sir?
Fine.
Fine. So you give me indication by raising hand the moment you feel that is the last question, because the number of questions are number of questions are there. So sir, I will start with the last question. An investor holding shares in unlisted company having an ISIN in CDSL is unable to dematerialize when DC has demat account in NSDL only. Why so? Why does he need to open another demat account with CDSL when he already has an account with NSDL?
Is it about an unlisted company you said in the beginning? Sorry.
Yes, sir. It's an unlisted company. It's an unlisted company.
So unlisted company we don't deal with. So I don't think.
Okay. Fine. So we'll move to next question, sir.
Listed companies. Yeah.
Okay.
So MCA is meant for Ministry of Corporate Affairs or the local ROC or whatever. I mean, because under their mandate, depositories are doing dematerialization, dematting of the shares. So what is the terms and condition? What are that I'll not be aware of. So,
thank you, sir. Thanks for your guidance. I'll request the person who has raised the question to go try to approach the MCA for further guidance. Sir, another question is structured products are very popular in Asian markets. It helps market participants to express and to take protected exposure to volatile equity market. Will SEBI relax issuance of structured products in line with other Asian markets?
Yeah, we are open to structured products, provided that it should not have a, what are structured products? The REITs, InvITs are also structured products. So convertibles are also structured products. So partly debt, partly equity, there are structured products. So we are open to structured products if it is really serving the purpose of diversification of investment. We are open to that. No issue.
So there is no.
Yeah.
So your answer is there is no question of relaxation. So SEBI is already allowing and doing the structured product markets in India. So that is already existing in our country.
Yes. So structured products are already there in India, and structured products are also encouraged wherever it is found to be suitable to the needs of the investors. But the structured product is too complex to understand and all that. I mean, depending on the complexity or simplicity, or depending on the acceptability, definitely we'll approve. But we are not. There is no point blank no to structured products.
Sir, one question, which when last time the BSc MD was there, this question we are asking this question to you also, because this question is very relevant for the current market. Do you feel kind of frenzy we are seeing in the IPO market is good for investors? More so, since this company has shown good performance only in last 10 to 12 months. I always tell to my friends, the same product for the existing company, you can get the share at 20 rupees. For the same company, it is coming right now with the IPO, it is coming the same at an issue price of 200 to 500 rupees. And there is a frenzy. People are investing in the IPO, but they are not investing in the current market. So what is your take on that, sir?
See, that's everyone talks about the frenzy only, and it's a decision of individual decision. So as a regulator, I cannot be an investment guide or advisor that you should buy or not buy. Definitely, yeah, Indian market, the P ratio that we talk about is definitely certainly very, very, very high. At the same time, there are experts who say that in dollar terms, Indian market the return in Indian market is very good. So the decision to buy with a lot of premium or win an IPO, vis-a-vis a decision to buy a stable company which is already a track record of 4 to 5, 6 years, and the share prices are stable at a particular level. This is something a call to be taken by the investor, how long he wants to be sticking to the company. If he's only there for taking a listing gain on the listing day, that is his take, then his strategy will be different. If he wants to stay and stick with as a loyal investor with the company on a long-term basis, then his take, definitely decision will be different. So therefore, if he is comparing within two companies, similar results in terms of performance over last 10 months, and one is coming out, one unlisted company coming to the market with the IPO with a lot of premium, and similarly placed another listed company having a good track record is being available at a lesser amount. it is something there itself he's finding the answer. So this is something investment decision, but he should be completely informed about the decision. That is the aspiration of regulator, that informed investor is a good investor for us. He should not take a decision under lack of information. Our aspiration is that our DRSP, the offer document, should contain every information possible. Still, if he wants to pay the premium, it is completely his own decision.
Sir. Yeah, the information required information, SEBI is ensuring that all the disclosure and informations are provided in the offer document, and it is the take of the investor to read the information or not. But it is presumed that those who are investing in the equity to the IPO, they are reading the information and they are well informed. So well informed investor, they win or they lose. They make money or they lose money. It is their take. I mean, nobody can have a say on that. Sir, the another question is, most of the fund raising is happening by way of OFS and not through fresh IPO. What is your take on this phenomenon?
Yeah, that's true. OFS is definitely much bigger figure than the rights, the fresh issues, because it is the unlisted companies during their unlisted stage. So they take money from private equity funds and so many other institutional investors. And it is the institutional investors and private equity funds, they had given the risk capital during the time when the company's future was uncertain. And it's really they put in their risk capital into those companies. And when the company was incubating with an idea in a very small scale, it was. So they raised funds in 2, 3, 4, 5 rounds of fundraising series. And when the company has started showing prospects for profit or good model, they come out. Obviously, they'll try to get out of the market fully, partially, whatever it is. And definitely, OFS is a natural phenomenon. It's not bad also, because they invested, they want to come out of the market. But the very fact that they nurtured the company all through these years, and the company grew under their guidance and also monetary and financial help. So, it's not like that. I have not seen any company where OFS, every pre-listing investor, 100% they're offering their shares. They're partly going out, and mostly they're staying loyal with the company itself. So that rather shows a good symptom that they want to monetize part of it, but they're still sticking with the company. You can take the name of Zomato also, the largest P fund, whoever has invested. Very few, 5-6% they divested. About 15,000 crore, still they are stuck with the company and they're loyal to the company. So OFS is not bad or good. It's just it's a call of the commercial compulsion of the investor who stayed invested with the enlisted company, about whom we are not knowing at all. When they're coming to public, we started knowing about the company. And if they need more money, they're definitely coming in that same offer. They're also asking more money for fresh capital also. So it's a combo. Basically, most of the companies are coming with the combination of both OFS as well as fresh issue. So there cannot be any negative or positive comment about it. If the company is expanding, want to set up 2-3 more factories or plant and machinery, definitely it will raise fresh capital. So that is also a good symptom that the company is raising fresh capital. At the same time, it had also loyalty of so many institutional investors. That's a good combination to see that the company is doing well. Yeah.
Sir, my last question, though I have 4 more questions, but I'll take this as a last question because it's a little bit heavy question. And we need a heavy answer from you because it will impact our entire economy and more to the capital market. How does SEBI plan to develop the corporate bond market in India? The reason being, today the equity market is going up. Every time the equity market may not be going up. I mean, that time the corporate need to look at the bond market. So how does SEBI plan to develop the corporate bond market in India? At present in India, most of the corporate fund is raised through private placement. So your take on that, sir?
Yeah, as I said a little while ago, the primary market is increasing year by year. People are coming with a lot of issuances. For example, in 2020-21, 1,147 issues in corporate bond market came, totaling 7.07 lakh crore. So in current financial year, so far only 193 issuances have come. So before that, 1920, it was 713, 5.94 lakh crore. So it is increasing. Primary market is increasing, definitely. And secondary market also, it is increasing. I mean, it's roughly around 20 lakh crores of bonds, debt instruments are being traded buy and sell in OTC markets. So, but the thing is that, as I said, mostly the trades happen concentrated only in few categories like AAA, AAA plus, or maybe a little bit of BB, BBB, etc. Very secondary market trades scantily, very rarely happens in the investment category or lower ranked rated papers. Only highly rated papers are traded. People have faith in that. So there's something has to be done to ensure that all the types of bonds, all rated papers are bought and sold in a liquid market, so that a proper yield curve can be built up across the rates, across the grades of the bond papers. So to have a proper yield curve, you need a secondary market which is liquid, where people really come and trade, buy and sell, they do across the categories and across the grades of bonds. So because for that, SEBI, as I said, a limited purpose clearing corporation is being set up with mutual fund industry supporting it. So because they are the main beneficiaries or the main victims when things are because of the secondary market dryness, there is no liquidity. So they are not able to buy and sell properly. So that limited purpose clearing corporation will come for promoting repo market in corporate bonds. For promoting repo market, we need market makers. Market makers also we are trying to engage, and some policy guidelines have been framed. And once repo market takes off, then I think there will be liquidity in the secondary market across different grades of papers. And of course, there's a backstop facility as the finance minister has announced in last budget. That is also being created with the support as well as support of the industry as well as support of Government of India. Backstop facility, that institution will be there when there will be no liquidity in the market. The mutual funds will try to sell. There will be no buyer. This backstop facility will ensure that it buys the papers from them and gives them liquidity so that they can meet the redemption pressure from the unit holders. So it's a chain process to develop secondary market. We need to have a good repo market. For getting a repo market, again, also there should be a backstop arrangement which will come to the rescue in bad and good times. So this ecosystem is being created, but at the same time, SEBI also has been urging the government that the debt market completely should be unified at the level of one level, so that government security GSEC market or the corporate bond market can be unified at exchange level, depository level, and there should be depositories and public debt management office of the RBI should be fungible. So that is the bigger picture I'm giving you. The short term, at least these measures are being taken. I told you primary market EBP, secondary market RFQ, which is going on well, because SEBI mandated mutual funds up to sell and buy 10% of their purchase on the RFQ. Then this LPCC and plus this backstop arrangement. Hopefully in coming months and a couple of years, things will be much better than what it used to be. Thank you.
Thank you, sir. So now, even though there is a lot of questions, but looking at your time constraint also, sir, we would like to say, give the final round of thanks to you. Though I was not fortunate to be participant to all your deliberations, but to find, my office must have prepared the detailed noting of your presentation. I will be get benefited there. But sir, we will request that whenever you happens to be in Kolkata physically, now since COVID has subsidized there, we would like to have your physical presence also. Now I will go ahead to offer a vote of thanks on behalf of the Merchant Chamber of Commerce. Sir, after a very engaging discussion, I take this opportunity to wholeheartedly thank you, sir, the whole-time member SEBI, for kindly gracing this webinar and enlightening our members on recent regulatory initiative in securities market. The knowledge and information that you have shared with us today will be valuable for all of those who are attending this important session, and side by side, the members of the committee whom these minutes are also circulated. I also sincerely thank all the representatives of the press, electronic media for their kind presence and continued support to us. Because this session is covered by the media also. And I'm sure SEBI will not mind if the media supports all the positive points that you have shared with the media and the members. With these few words, I express my heartfelt thanks to the members, to the media, to the business associates for joining this webinar. I can't request everybody to carry this board with applause, but at least with heartfelt thanks from each one of you. Thank you, sir. Thank you very much. And look forward to have your kind physical presence in Kolkata. Whenever you have a plan to come to Kolkata, we can organize the meeting, sir, even with a shorter notice, if you happens to be there in Kolkata at any point of time. Thank you, sir.
Thank you so much,
Thank you, sir.
Subodhji. Thank you.
Thank you, sir.